Welcome back, Freedom Savers. Today, as I promised, each and every month, sometime approximately the first week of the month, I'm going to be doing a My Portfolios versus the Market video. So we can see overall how are my portfolios performing compared to how the market is performing. Am I outperforming them? Am I underperforming them? Which portfolios are doing good? Which ones are doing bad? How far off are they? Are they close? Are they just total crap? Etc., etc. So that's what this video is about, guys. We're going to compare my portfolios from the time they were created to now compared to the market at the time I created the portfolio to now. So let's get into it. All right, so I've updated the spreadsheet. And as we go through this, we can see that the Roth overall has a 3.91% performance so far. We are up by 3.91%. The market, S&P 500, since I created the Roth IRA, is down by 3.01%. The Dow is down by 0.19%, and the NASDAQ is down by 3.9%. So the market average, if you take those three and average them, is down by 2.37%. So me being up by 3.91% means I am beating the market on the Roth IRA by 6.28%. The aggressive dividends. Well, the market's up 6.17%, or sorry, the S&P 500 is up 6.17%. Blah, 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 I can't talk. The Dow 30 is up by 6.31, NASDAQ up by 8.23, for an average of the market being up 6.9% since I created the aggressive dividends portfolio. The aggressive dividends portfolio itself is up 8.3%, so we are beating the market by 1.39%. The random stock portfolio, completely random stocks, well, it's still doing fabulous. S&P 500 is up by 13.72% since I created that portfolio. The Dow is up 13.79%. The NASDAQ is up 15.55%. So the market average is up 14.35%. My portfolio for the random stock portfolio is up 26.76%. So I am beating the market by 12.41% with completely random stock picks. Unbelievable, guys. Unbelievable. All right, the no debt allowed portfolio started down December 28th. S&P 500 is up 12.2% since then. Dow's up 12.12% since then. The NASDAQ is up 14.79% since then. So the market overall is up by 13.04% average. My portfolio, the no debt allowed portfolio, is up 8.35%. So I am not beating the market with the no debt allowed portfolio. The market is actually beating the no debt portfolio by 4.69%. Monthly dividends. Monthly dividends I created January 3rd. S&P 500 up 12.5, NASDAQ's up 12.3, or sorry, Dow's up 12.3, NASDAQ's up 15.35. So overall average of the market being up is 13.39%, and my performance on the monthly dividend portfolio is only 5.97%. But I am ahead. I'm up by 5.97%, so I'm okay with this. But I'm not beating the market. The market is beating me by 7.41%. No rules, the no rules portfolio. Obviously, I'm going to beat the market on this because of my risky picks. But anyways, I created this January 4th. The overall market average since January 4th is 14.22%. This portfolio, no rules portfolio, is up 51.46% because of my PG&E move and General Electric move, and SOIs is doing well. So I am beating the market by 37.24% on that portfolio. The best beginner portfolio, this is the one where I have the ETFs that I suggest for beginner investors. S&P 500, since this was created on January 30th, so this is 1 month, is up 5.66%. Dow's up 4.8%, and NASDAQ's up 7%. Overall market average is up 5.85%. The best beginner portfolio is up 5.67%. So the market is actually beating this portfolio by 0.18%. Not too bad. But here's the thing to keep in mind with this portfolio, guys. This is for inexperienced investors who aren't out to beat the market. They're just trying to follow the market. So they're pretty much in range with a 0.18 at this point. And if you look here, the 5.67% is actually beating both the S&P 500 and the Dow. So we're beating 2 of the 3 major indexes. The only one that's outperforming it is the NASDAQ. And with the NASDAQ, you can see it's outperforming the other 2 indexes on a regular basis in a bull market. But also in a bear market, when the market goes down, it has much bigger losses as well. So, I mean, the Dow only had 0.19% loss here, whereas the NASDAQ had negative 3.9. S&P 500 only had negative 3.01. So NASDAQ will lose more money in a down market, but it'll gain more in an up market. So there you go. Overall, the best beginner, if you take the average of the 3 indexes, is not beating the market, but it is beating 2 of the 3 indexes. Zero expense ratio. This is the Fidelity zero expense ratio portfolio, where I'm invested into 2 index funds. They're not ETFs, they're index funds. And they have 0 expenses at all. Like, there's no expenses even to own these things. So since I created this on February 4th, so less than a month ago, the market average is 3.99%. This portfolio is up by 3.89%. So the market's beating this portfolio by 0.10%. So again, it's following the market, which is what's expected. We want it to follow the market. And again, 3.89% beats both the S&P 500 and the Dow. The only one that's not beating is the NASDAQ. And so that's taking that average up, causing us not to beat the overall average of the market. But we are beating the S&P 500 and we are beating the Dow 30. So overall, how are my portfolios doing? Well, overall, the market average is up by 9.34%. And my portfolios are up by 15.77% on average, which means overall I am beating the market with my 174 stocks plus a bunch of ETFs and funds. Anyways, overall I'm beating the market by 6.43% as of March 3rd, 2019. And actually, you know what? I did not change this. Let me change these calculations. My bad. This needs to be an 8, and this needs to be an 8. I put my little note here to remind myself of that, since I added the 8th portfolio. So let me recorrect those figures. The actual numbers are, my portfolios are up by 13.8%, and I'm beating the market average by 5.63%. And this is just a little calculator I use to calculate all these numbers. So there it is, guys. I am currently still beating the market overall. The best beginner and zero expense ratios, the types of portfolios I would suggest for beginner investors, are doing very well, and they are also beating the market if you only accounted for the S&P 500 and Dow. They're not beating the market, including the NASDAQ, with its huge gains compared to these other ones. But even with that, they are still pretty much following the market. And this is why I suggest these portfolios for beginner investors. You will still build wealth over time. So there it is, guys. The only portfolios that are really not doing good compared to the overall market would be my no debt allowed portfolio and the monthly dividend portfolio. I still think these are valid investing strategies to invest in only companies that don't have debt, because those are going to be safer investments over long term, because what's the chances of them going bankrupt if they have no debt, right? And monthly dividends, I think that's valid. You're trying to get monthly income, and it's not about the actual growth of the portfolio. But with dividends paid, you would hope that it would be matching the market as well, and it is currently not. So we'll see how that goes over a longer term, but for now, that's the worst performing portfolios, and these are performing extremely well as far as I'm concerned, these beginner ones, even though they are in the red compared to the average. So there you go, guys. I hope you enjoyed this comparison, and I'll be doing this every month so we can see how the portfolios are doing, and whether we can or can't beat the market in the long term. All right, I hope you're all doing great. Have a good one. All right, guys, thanks for watching. I appreciate it. Be sure to hit that subscribe button down below, and if you liked the video, hit that like button for me. If you want to hear any specific type of information, anything that you're interested in, you have any questions, just drop me a comment down below. Let me know what you think. Let me know your opinions on this video or any other video I've made. And if you know anyone else that might be interested in this video, please be sure to share it on your social media and share the knowledge. Thanks, guys.